$89.81. That is where silver closed on March 10th, 2026, up 6.25% in a single trading session. Surprised. A single day. And while most people were watching their stock portfolios bleed out and arguing about oil prices because the Strait of Hormuz is effectively closed, silver quietly posted one of the most significant single-day moves in this entire multi-year bull run. Excited, 6.25% in one day, up from 84.53 the morning before. That is $5.28 gained in hours. Now, I need you to really sit with that number for a second, because it's not just the percentage move that matters here. It's the context. It's what's sitting underneath that price move like a fault line that nobody in mainstream finance wants to talk about. Because here's what nobody's telling you. This 6% rally didn't happen in a healthy, well-supplied market. It happened against the backdrop of the most severe physical delivery stress the COMEX has seen in its modern history. And by the end of this video, you're going to understand exactly why that distinction matters, and why the next move in silver could make this 6% day look like a warm-up act. Stick with me, because what I'm about to walk you through is not a prediction, it's not a theory. It is documented, verifiable, publicly available data, and it tells a story that should have every serious investor paying very close attention right now. Let me give you the full picture of where we are. Silver started 2025 at around $28.92 an ounce. As of March 10th, 2026, we're sitting at $89.81. That is a gain of approximately 210% in roughly 14 months. Gold, over the same period, went from under $3,000 to $5,228.40 on that same March 10th session, itself up 2.44% on the day. So gold had a great day, silver had a better one. Silver outpaced gold by nearly 3-to-1 on a day when both metals were surging. That pattern, silver outrunning gold, is something precious metals analysts call a beta event. When silver moves faster than gold on the upside, it historically signals one of two things: either a speculative blow-off top where momentum traders pile in and then get wrecked, or the early stages of a genuine physical supply panic. And right now, based on everything the COMEX warehouse data, the delivery reports, the Shanghai inventory numbers, and the positioning data are all showing, I believe we are watching the second scenario play out in real time. And here's where I want to ground this in something concrete, something you can verify yourself at cmegroup.com, because I'm not asking you to trust me on any of this. I'm showing you the numbers. Let's talk about the COMEX and what's actually happening there, because this is the nerve center of the entire silver pricing system, and it is currently under extraordinary strain. COMEX registered silver inventory, that's the metal that is officially designated vault-ready, available for delivery against futures contracts, stood at 240 million ounces back in April of 2020. By the end of February 2026, that number had collapsed to 86.13 million ounces. That is a decline of 153.87 million ounces, a 64.1% drawdown in under 6 years. Think about what that actually means. Nearly 2/3 of the deliverable silver supply that existed at COMEX in 2020 is gone, consumed, withdrawn, absorbed, and that is not speculation. That is the CME Group's own warehouse reporting data. Now here's the part that makes the current situation extraordinary. On what's called First Notice Day for the March 2026 delivery contract, February 27th, delivery notices were filed for 10,526 contracts. Each COMEX silver contract represents 5,000 ounces. So 10,526 contracts times 5,000 ounces equals 52.63 million ounces of silver that participants are demanding physical delivery of in March, against a registered inventory of 86.13 million ounces. Let that ratio sink in. More than 60% of all the deliverable silver at COMEX has been claimed in a single delivery month. According to analysis published by the financial content services cited by CME data, this delivery demand represents more than 60% of the total registered inventory, leaving a dangerously small margin for error. That phrase, dangerously small margin for error, is not language from a fringe blog. That's the assessment being published alongside official exchange data. And this is where I need to talk to those of you who are new here. If you're not subscribed yet, my analytics show about 3 out of every 4 people watching this video haven't hit that subscribe button. Look, if this kind of analysis is cutting through the noise for you, if you're getting numbers and context here that you're not finding on CNBC or Bloomberg, then hit subscribe. That's how I know who the real community is, and it signals the algorithm to show this content to more people who actually need to see it. It takes 2 seconds and it genuinely helps. Okay, back to the COMEX stress test, because this gets deeper. Let me give you some historical context so you understand how unprecedented the current situation truly is. In January 2026, and I want to emphasize, January is historically a minor delivery month, not a primary one, COMEX processed delivery requests for somewhere between 33 and 40 million ounces of silver. To put that in perspective, in a typical January before 2026, COMEX would see 1 to 2 million ounces delivered. The January 2026 figure represents a 7 to 10 times increase over historical January averages, in a non-primary delivery month. Then February came in with 5,036 contracts delivered, totaling 25.18 million ounces. That was the highest February delivery volume in modern COMEX history. And now March, the primary delivery month, opens with 52.63 million ounces already standing for delivery on day one. This is sequential escalation. And what this tells us is that whoever is on the other side of these contracts doesn't want paper settlement. They want the metal. They want bars in a vault they control. That behavior doesn't happen when markets are functioning normally. That is a form of financial triage, getting physical while physical is still available. Now let me show you something that makes this even more striking. Shanghai. The Shanghai Futures Exchange is China's primary silver futures market, and it has been undergoing its own inventory drawdown. Back in November 2025, Shanghai registered approximately 559 tons of silver in exchange vaults. By February 2026, that number had dropped to 318.5 tons. That is a 43% decline in just 3 months. Combined, the COMEX drawdown and the Shanghai drawdown represent roughly 161 million ounces of silver leaving exchange systems over about 6 years, which accounts for about 19.6% of the 820 million ounce cumulative supply deficit that has built up since 2021. Let me repeat that. There has been a structural supply deficit in silver for 5 consecutive years. According to the Silver Institute's World Silver Survey, in 2024 alone, the global silver market ran a deficit of 148.9 million ounces. In 2023, it was 200.6 million ounces. The cumulative deficit from 2021 through 2025 has been estimated at approximately 820 million ounces. That is 820 million ounces of silver that was consumed that didn't exist in the supply chain. Where does that metal come from? It comes from above-ground inventories, from exchange warehouses, private vaults, allocated accounts, and those inventories are now visibly, measurably running down. But here's what makes this a truly 2026 story and not just a repeat of every previous silver squeeze narrative. Silver was officially added to the U.S. critical minerals list in late 2025. That's not symbolic. That's a regulatory designation that affects how industrial users are allowed and incentivized to procure the metal. And once that happened, something shifted in corporate behavior. Electronics manufacturers and solar panel producers started doing something they hadn't done in decades. They started bypassing the futures exchange entirely and negotiating what are called offtake agreements directly with mining companies, lock in future supply at a contracted price before it even comes out of the ground. That behavior, that complete avoidance of the futures market, does 2 things simultaneously. It removes those industrial buyers from the pool of demand on COMEX, which might sound like it relieves pressure, but it also removes potential sellers. Every ounce spoken for through a direct offtake deal is an ounce that will never show up in a COMEX vault, and that process is accelerating. Now think about the solar numbers. Industrial demand for silver hit a record 680.5 million ounces in 2024, according to the Silver Institute. Solar alone consumes more than 200 million ounces annually, roughly 20% of total global supply. China installed more solar capacity in the first half of 2025 than the entire rest of the world combined. The European Union has mandated solar integration in new buildings starting in 2026. Saudi Arabia is building massive solar infrastructure, targeting 50% renewable electricity by 2030, and every single solar panel uses silver. There is no commercially viable substitute at scale. The copper metallization work being done by companies like ICO in China is promising, but even at full projected scale by year-end 2025, it saves perhaps 1.6 to 2.25 million ounces annually. Against a 200 million ounce annual solar demand figure, that's rounding error. So let me now bring in the macro layer, because silver isn't just an industrial story right now. It's sitting at the intersection of 3 massive forces simultaneously. You've got the physical supply crisis I just described. You've got geopolitical escalation. As of this week, Middle East tensions have effectively closed the Strait of Hormuz, pushing crude oil toward $120 per barrel, which is injecting serious inflation fear into every asset market. And on top of that, you've got the dollar situation. Gold closed at $5,128.40 on March 10th. JP Morgan has publicly projected gold could reach $6,300 per ounce by the end of 2026. When gold is at $5,000 and still being projected higher by the largest bank in America, you're in a fundamentally different monetary environment than you were 2 years ago. And here's the thing about silver in that environment that most people miss. Silver has historically moved with gold during monetary panic phases, but then it accelerates. It has more industrial demand. It has more physical scarcity. It has a smaller market. When the same capital flows that are going into gold start looking for the next move, silver is the obvious destination. JP Morgan's own research projects silver averaging $81 per ounce for all of 2026, and they said that as an average, not a peak. With silver already at $89.81 in early March, the year is running significantly ahead of even their relatively bullish baseline projection. Bank of America's head of metals research, Michael Widmer, has issued what may be the most extraordinary institutional silver price call in modern history, a range of $135 to $309 per ounce by end of 2026. That's not a fringe call. That's Bank of America putting their name on paper saying silver could triple from current levels. Their thesis is built on historical gold-to-silver ratio compression, at the all-time high gold-to-silver ratio of around 50 to 1, which is where it sits today roughly. If gold hits $6,300 and the ratio even partially compresses to historical norms, the math starts producing numbers that look unreal until you actually run them. Now here's where I want to walk you through the historical pattern, because this isn't the first time we've seen a dynamic where physical scarcity and paper markets have diverged catastrophically. Let me show you 3 examples. The Hunt brothers situation in 1980 is the one everyone knows. Nelson Bunker Hunt and his brother Herbert accumulated roughly 200 million ounces of silver, physical metal and futures contracts, through 1979 into early 1980. At the peak in January 1980, silver hit $49.45 an ounce, which was the all-time high at the time. What broke the market wasn't fundamentals. The COMEX changed the rules mid-game. They imposed Silver Rule 7, essentially limiting new long positions. They forced liquidation. The margin requirements were jacked so high, so fast that the Hunts couldn't hold their positions. Silver crashed from $49 to under $11 in 2 months. The lesson people drew from this was, silver squeezes always fail. But here's the part they forget. The Hunts were a single family with a speculative position. What's happening in 2026 is industrial users, solar companies, electronics manufacturers, defense contractors taking physical delivery because they literally need the metal to operate their businesses. You can't margin call a solar panel factory. The second example is the London Metal Exchange nickel crisis in March 2022. Tsingshan, a Chinese nickel producer, had a massive short position in LME nickel futures. When nickel prices spiked due to Russia's invasion of Ukraine disrupting supply, the losses became so catastrophic that the LME actually halted trading, canceled trades retroactively, and suspended the market for days. I'm not saying that's what happens with silver. I'm saying that when physical commodity markets and paper markets diverge far enough for long enough, exchanges don't just let prices discover themselves, they intervene, they change margin requirements, they introduce cash settlement alternatives, and that intervention is itself a signal, because exchanges don't restructure functioning markets. The third example is what happened to silver itself in August 2011. Silver had run from around $18 in late 2010 to $49.51 in April 2011. Then the CME raised margin requirements 5 times in 9 trading days. 5 times, prices crashed back below $35 within weeks. What I want you to notice about this pattern isn't that it crashed, it's what happened after. Silver found its floor, consolidated, and the fundamental thesis remained intact because the industrial demand didn't go away, the physical deficit didn't disappear because of margin hikes. And that is the exact situation we are in today. Now let me show you the smoking gun, and I want you to pay very close attention to this math because it is the single most important thing I'll say in this entire video. COMEX's own stress index data, compiled from their daily warehouse reports, currently shows a coverage ratio of 14%. That is registered silver inventory divided by total outstanding paper claims, expressed as a percentage. The threshold below, which the exchange itself considers conditions to be in stress territory, is 15%. We are below stress territory right now. Paper leverage is at 7.1 times, meaning there are 7.1 paper claims for every ounce of deliverable silver in the COMEX system. And at the current pace of withdrawals, 24.1 million ounces have been pulled from COMEX registered inventory in just the last 30 days. The registered silver would theoretically be exhausted in approximately 70 trading days. That's roughly 3.5 months. Now, I want to be careful here and say something clearly because this is YouTube and I am not a financial advisor. I am not saying COMEX will default. The exchange has tools. They can reclassify eligible silver as registered. They can raise margins to force speculative liquidation. They can introduce cash settlement alternatives. They have done all of these things before. What I am saying is that the mathematical pressure on this system is more extreme than it has been at any point in the last 45 years. The exchange's own composite stress index combines the coverage ratio, inventory trend, paper leverage, and vault outflows. Every single one of those 4 inputs is currently flashing red. Here's the disconnect that I think is the most revealing signal in this entire story. The paper silver market, futures and options on COMEX, said on January 29, 2026, that silver was worth $121.62 an ounce. That was the all-time high. Then, in essentially one trading session, the price collapsed nearly 33% to around $81, a $40 crash in a single day. Treasury Secretary Scott Bessent went on record attributing those extreme swings to Chinese traders engaged in speculative activity. But here's what the physical market said during that exact same period. In the week of that crash, over 33.45 million ounces of silver, 26% of total registered COMEX inventory, were physically withdrawn for delivery. Not sold, withdrawn. People who had paper contracts took delivery of actual bars. They moved real silver into their own custody. Think about that for a moment. The price was crashing, supposedly because it had been overvalued and speculative froth was being purged. But the people who actually know what physical silver is worth weren't selling. They were taking the metal. They were standing in line to get their bars. This is the fundamental tell. When prices crash, but physical demand for actual delivery accelerates, one of those two things is sending you the wrong signal. The paper price said, silver is worth less. The delivery behavior said, we want every ounce we can get. In a healthy, well-functioning market, those two signals don't coexist. You don't see massive physical accumulation at the same time as a supposed speculative purge. That divergence tells you that somebody in the paper market is setting a price that does not reflect what the physical market is willing to pay for real metal. Let me also give you the China dimension of this story because it's critical and it's been dramatically underreported in Western financial media. In 2025, China officially reclassified silver as a strategic material and imposed export restrictions. China is both the world's largest industrial consumer of silver and a major producer. When they restrict exports, they don't just remove supply from global markets. They signal to every other nation that silver is a resource to be hoarded, not freely traded. That is a geopolitical move, not a market move. And it has fragmented the global silver market in ways that are still being priced in. The Shanghai Futures Exchange has been trading silver at premiums of $3 to $5 per ounce above COMEX futures. That geographic price spread isn't supposed to exist in an efficiently functioning global commodity market. Arbitrage should eliminate it. The reason it persists is that Chinese silver can't freely flow to New York to cover COMEX delivery shortfalls. The physical market is fragmenting along geopolitical lines, and the paper market in New York is only now beginning to catch up to that reality. Meanwhile, emerging market central banks have been accumulating silver alongside gold, a trend identified by analysts at Trading Key and corroborated by Swiss commodity analyst Jochen Steiger, who lays out a sequential price target structure of $111, then $146, then $185 within the next 12 to 18 months, citing what he describes as a permanent shift where physical shortages have broken the paper pricing mechanism and Eastern markets have taken control of price discovery. You can look up that interview. It's from early March 2026. The argument is worth understanding whether you agree with his conclusion or not. Now let me bring this home and make it practical. What does all of this actually mean for you? And I want to be very clear here. Nothing in this video is financial advice. I'm a researcher and analyst, not your broker. Please do your own due diligence and consult a licensed financial professional before making any investment decisions. With that said, let me give you the practical framework for understanding what this moment means. First, if you already hold physical silver, actual coins or bars in your possession, you are holding something that the COMEX stress data says is in genuine short supply. The coverage ratio is below the exchange's own stress threshold. The arbitrage between paper and physical isn't functioning correctly. The metal in your hand is not the same thing as a futures contract on a screen. Second, if you're watching this and you've been sitting on the fence about the silver thesis, understand what you're actually deciding between. You're deciding whether the paper price at any given moment is the thing to trust, or whether the behavior of the large institutions who are taking physical delivery, who are negotiating direct offtake deals, who are draining exchange inventories, is the thing to trust. Those two signals are currently pointing in opposite directions. Third, Watch the COMEX warehouse reports. They are published daily at tamigroup.com. Watch the registered inventory number. If that number continues falling towards zero, the exchange will either raise margins aggressively to force liquidation, which has happened before, and produces violent short-term price drops, or physical supply will become genuinely unavailable for paper settlement, which would produce the opposite outcome. Knowing which scenario is developing is the single most important variable to monitor right now. Fourth, keep your eye on the gold to silver ratio. Right now it sits at roughly 58 to 1, meaning gold is 58 times more expensive than silver by price per ounce. Historically, that ratio has compressed as far as 15 or 16 to 1 during full-on silver bull markets. At 5,228 gold and a 58 to 1 ratio, silver should be at $90, and that's almost exactly where we are. If gold continues to $6,300 and the ratio compresses even modestly to 40 to 1, you're looking at silver above $157. If the ratio compresses to 25 to 1, you're at $252. I'm not telling you it will. I'm showing you the math. Fifth, the iShares Silver Trust, ticker SLV, had assets under management of $46.2 billion with daily trading volume of 175.5 million shares as of early 2026. That ETF is the retail and institutional access point for silver exposure. Watch those flows. When institutional money rotates into SLV at the same time physical inventories are declining, that's the setup that preceded the January spike to $121. Sixth, understand the timeline of these dynamics. The March COMEX delivery cycle runs through the end of March. The May contract becomes the next focal point for delivery stress. July is after that. If March deliveries stress the system but don't break it, the same dynamics intensify in May, and again in July, because the metal that wasn't available in March doesn't magically reappear. Every delivery cycle that runs without replenishing inventories brings the system closer to the mathematical edge. And seventh, this is the one point I want to land most clearly. The silver market in 2026 is different from every previous silver squeeze in one fundamental way. This is not a speculative squeeze by a small number of leveraged traders. This is structural industrial demand from solar manufacturers, electronics companies, defense contractors, and EV producers who literally cannot make their products without silver. You cannot margin call a solar factory. You cannot tell Samsung or TSMC that silver has gotten too expensive and they need to unwind their positions. The demand underlying this market is not financial, it is physical. And that changes the end game. Let me bring this full circle because I want to make sure the beginning and end of this story are connected in your mind. We started with a single number, $89.81, up 6.25% in one day on March 10th, 2026, a move that happened against the backdrop of a COMEX system where registered silver has declined 64.1% from its 2020 peak, where the coverage ratio sits at 14%, below the exchange's own stress threshold, where paper leverage is 7.1 times deliverable supply, where 52.63 million ounces were demanded for physical delivery on the first day of the March contract, against only 86.13 million ounces total available. And that delivery pressure didn't come from nowhere. It came from 5 consecutive years of structural supply deficits totaling approximately 820 million ounces cumulatively. It came from industrial demand that hit a record 680.5 million ounces in 2024, from solar consumption that's eating more than 200 million ounces annually, from China reclassifying silver as a strategic asset, from a gold market that has already crossed $5,000 and is now being projected to $6,300 by JP Morgan, from Bank of America placing a formal published price target with a ceiling of $309 per ounce before the end of this year. The people who didn't see the Hunt brothers situation coming kept saying silver couldn't keep going up. The people who didn't see the LME nickel crisis kept saying industrial shortages were temporary. The warning signs were there. The data was available. Some people read it and positioned themselves. Most didn't. I am not telling you what to do. I am showing you the numbers and the patterns and asking you to think carefully about what they mean, because the evidence available right now is more compelling and more specific and more quantitatively documented than at any previous point in the history of the silver bull market. One last thing I want you to think about. Throughout all of human monetary history, the Spanish Empire exhausting its Peruvian silver in the 1600s, the Dutch trade empire that built itself on commodity exchanges, the British Empire transitioning away from the gold standard, the pattern is always the same. Physical scarcity builds slowly. Paper markets ignore it for years. Then the adjustment happens all at once. Not gradually, all at once. Silver went from $28 to $121 in about 15 months. Then it crashed back to $70 in a matter of days because of margin changes. Then it climbed back to $89.81 in another 6 weeks. Every leg of this is more volatile than the last. Every leg draws more institutional attention. Every delivery cycle at COMEX drains the available supply further. And each time the exchange intervenes to prevent a price spike, the physical scarcity that caused it doesn't go away. It just gets deferred. The pressure builds. The only question, as I see it, is whether the paper price or the physical delivery behavior is telling you the truth about what silver is actually worth today. The COMEX stress index combines 4 indicators, and it's currently registering high physical pressure. That's not my opinion. That's the exchange's own composite measure. Drop a comment below and tell me this. Do you think the March delivery cycle resolves cleanly, or do you think we're about to see another intervention from the CME in the form of margin hikes? I read every single comment, and your perspective on what's happening on the ground, whether you're a physical holder, a miner, an ETF investor, or just someone watching this situation from the outside, genuinely shapes what I cover next. This community is the best source of real-world signal I have. If you haven't subscribed yet, now is the time. Hit that button. The next video is going to cover what happens when the COMEX stress index goes from high to extreme, what the exchange's options are, what the historical response has been, and what it means for everyone holding silver in any form. You don't want to miss that one. Thank you for watching. Do your own research. This is not financial advice. And pay attention to the warehouse reports.